So this week on the podcast, Sean, let's get into some 2025 tax break conversations, maybe some adjustment opportunities, especially for the folks that are working with you, or they're thinking about it, or they're checking out the podcast, and maybe they're still working, right? Maybe not so much retiree or retired folks, but retirees, pre-retirees, excuse me, if I can talk today. Kind of talking about just some of the numbers. Maybe it's important to take a look at some of this stuff, just know where the changes are at. Coming up for the new year, right? Because at the time we're taping this, we're in early April here. So most people have probably got their taxes done. Didn't wait till the last second anyway. At least I'm hoping anyway. What's going on, man?
Right.
You doing all right?
Yeah, I'm doing good. I'm doing good.
Yeah, you got your taxes done? You good?
Yes. I mean, all of our corporate taxes are done. They're just finishing up their personal tax return now, and just waiting to see that.
Yeah, for sure. Well, and again, like most people are probably already, got this stuff handled for 24, but let's talk about some of the stuff for 25, right?
Yeah. All right.
As we're moving through this calendar year, because again, it is April, you may want to make some changes, right? So obviously we know every year the IRS makes some sort of adjustments to the tax brackets and whatnot. So what are some of the changes? What are some of the numbers we might want to look at for this calendar year? Like, I think it's 30,000, I think this year for the standard deduction.
Yeah. Standard deduction goes up from, 2024, it was 29,200. Okay. There's always, well, not always, but there's usually an inflation adjusted amount. And
right.
So for this year, it's 30,000 if you're married filing jointly. Mm-hmm. 2024 for a single filer, it was 14,600. And this year it's half of the 30 for 2025. So it's $15,000 standard deductions. But when you start to look at taxpayers that are over the age of 65, there's an additional standard deduction. And so coming into 2025, it's going to increase by $50 each filer, which would be about $1,600 per person if you're married, $1,600 individually if you're single. So that's an additional standard deduction on top of the 30,000.
So if you're married, you're talking about $34,000 in deductions for 2025 if you're over 65. And so, which is why we know we can't itemize now, right? So most people are probably going to wind up, just using the standard deduction. Is that what you guys see a lot too? Because it's hard to itemize right now, which that was the point of the TCJA back when they put it in 2017. That was one of the big points, was to just make it easier, right? Because you have this higher deduction, standard deduction.
Yeah, most people that we work with, they don't itemize, with the exception of the business owners or or high charitable giving families. But even then, if they're of age, if they're 70 plus, we can do a qualified charitable distribution that is a direct, straight across distribution from IRAs to the charity of their choice.
Right.
And it doesn't affect their standard deduction. So they still get that full standard deduction and exemption.
Oh, well, that's good. Yeah. Well, speaking of those types of accounts, let's look at some of the numbers for 2025. So the 401k, if you are still working, right? If you're maybe a pre-retiree, if you're like, my age or your age, if you're in your, 40s or 45, 50, 55, you're still working. The 401k, if you're doing the company sponsored plan, this kicked up a little bit too.
Yeah. 23,500 now.
Yeah.
Which is up. It's up an additional $500. If you're over the age of 50, you get to do an additional $7,500.
Yeah.
So now you can do 31 grand. But if you're over the age of 60, you can do an additional $11,250.
Now, this is the funny one, Sean, right? Because this one's new this year, I think, because it's part of the Secure Act 2.0 changes. And it's goofy because it's only for 60 to 63, the age range, right? It's weird. It's a weird one.
Yeah, they're just trying to get those that are like just on the cusp of retirement, an additional, deposit into their 401k, an additional savings benefit, because usually as you transition closer to retirement, you're at your higher income working years.
Right.
And so, in a lot of cases, people have their homes paid off, so they've got excess cash flow. So they're looking to go ahead and save as much money as possible.
Right. And that's a great point, right? You're talking, if you are in this unique 60 to 60 to 360, 63 range.
Right.
Talking with 34,750. Now, maybe, people might go, well, that's I can't just dump 34 grand in my, 401k in the course of a calendar year, but maybe you can, because you're probably in your highest earning years. You certainly probably don't have the kids on the payroll. So if you
Right.
do, like if you go in for a consultation, with somebody like Sean, people come in to see you, Sean, they're running the numbers and they're like, yeah, we're a little bit, we've done the math, we've done the planning. You're a little bit short of your goal, let's say, to get to retirement. Well, this is a good window for these next 3-4 years to sock money away. It gives you a great opportunity.
Yeah, truth be told, like a lot of families, not all, they saved the max in their 401k by like September, right? They're
Okay.
already contributing high savings rates because they're trying to focus. And then those last 3 or 4 months of the year, they're trying to figure out what to do. Now with the changes in laws, they can extend that out maybe October or November, where they're not trying to sock away as trying to figure out places to save that extra
as aggressively.
money.
Yeah.
Yeah. It's just part of the 401k now. I mean, they're saving well over 34,000 a year per spouse, if possible.
Right.
Which is a huge benefit for those last 3 years.
Oh yeah. If both of you are doing that for, 3 years, that's a good chunk. I mean, you're talking about 100 grand basically in 3 years times 2. If you're both doing it, that's $200,000 towards the retirement nest egg. Not bad.
No, and depending on if your 401k has a Roth option or whatever it may be, those same limits apply.
Very true. And that's a great point, because the IRA contributions, they didn't do it. So they do this goofy stuff with the 401k, and then they did 0 changes to the IRA this year.
Yeah, they just left it at $7,000, right? So, but if you're over 50, you can put 8,000 in. I mean,
it's not terrible. I mean, if you're 50 and you're at the catch up, $8,000 a year into your regular IRA for, let's say, 15 years until you get to 65, that's still not chump change.
No. And plus, even if you did minimal growth over a 15-year period, I mean, you're going to have, $100,000 just contributed into it.
Right.
But now, even if you get, a 4.5% growth rate over that 15 yeyears, that account doubles. So it's not like there's a lot of benefit to continuing to save as much as you can tax efficiently. But the thing to remember with all of this, we're talking about IRA limits, which also goes towards Roth IRAs.
Right.
Talking about 401k contribution limits. We don't want to forget about how taxes will be affected down the road. We don't want to be too overly invested in pre-tax style investments that are going to be taxable down the road, and we have no idea what future changes in tax law are going to bring. So part of the process is not just saying, hey, let's dump it all into traditional a 401k or traditional IRA.
Right.
Start to think about in your planning, do we incorporate Roth options or Roth 401k options if it's available inside of your employer?
Well, that's a good point, because, talking about the IRA or the 401k, the work sponsored plans. I mean, let's just say you are socking 30 grand away, based on some of those numbers we gave into your, workplace option plan. And you do want to worry about the tax situation. Well, you still could do conversions, especially if they do extend the TCJA, which at the time we're taping this, they have not done yet. Right. So we'll see if I'm sure that's something that the administration wants to get done, but they haven't done that yet. So we'll see if that happens, because if it does, then it gives you a chance to Roth over time, especially if you do have $500,000 or $750,000 in a 401k and you want to move that to a Roth. But that's a great point you made a minute ago. If work does offer that new 401k Roth option, which is only a couple of years old now, certainly worthwhile to talk about.
Yeah. Well, and part of this, all these changes, that more and more companies now have the opportunity to offer a Roth match. So as an employer, they can match their contribution into your Roth. Now,
versus the normal. Yeah.
Yeah. You've got to pay taxes on the contribution, but still, tax-free money in my opinion, is a vital component to the plan. Yeah, we want tax deferred, we want pre-tax, but having those various buckets of pre-tax, tax-free,
right,
and then the after-tax money, if you can have all three of those buckets and still get those high contribution limits, your plan will most likely be better off from an income and a tax perspective down the road
Gotcha.
than if you just invested in pre-tax solutions.
Now, let me ask you. So, when you're first meeting with folks and you're running through that, and they're saying, "Hey, they're still working," is it looking at like what their income levels are? Because does it make sense to maybe still have them contributing into the regular 401k, or again, or the Roth option if it's there? Is it all just kind of a unique person by person situation, right? There's no kind of across the board. Hey, you're this. Everybody should just do the Roth 401k if possible, right? It's not like that.
No. We'll do a full tax analysis to determine, all right, where do you sit now in your working years, and what's going to be the most bang for your buck currently. But
because based on your income limits, you might want to reduce your taxable income, right? By doing, let's say the normal.
But there's not going to be a huge difference in your taxable income. We may look at adding in Roth, but then we'll also look and say, all right, you're going to retire at 62. Your needs are income needs are this, your income's going to go down. Let's take a look at doing Roth conversions. So we'll look at it from both sides. Do we contribute more to the Roth side early on while you're still working?
Mm-hmm.
And or do we do Roth conversions down the road once you retire?
Gotcha. All right, so I'm not sure what the baseball analogy would be for this next one, but I'm going to go with horse racing because it's the time of year we're in here in April. What's the dark horse in this Kentucky Derby options here? What's some of the numbers for the HSA, right? HSA is a very cool item to use if you can have access to one. Again, these are workplace plans and things of that nature. But talk to us a little bit about the HSA and kind of what's your thought, because it's a great tool if you utilize it correctly.
Yeah, I mean, the HSA is fully deductible, right? And the money comes out tax-free. So
it's triple tax advantaged, right?
Yeah, so you get a deduction, it grows tax deferred, comes out tax-free. This year, families can contribute. I just got it right here. I'm just looking at the new updated amounts. It's $8,550 that a family could contribute to an HSA. I mean, that's a big deal. That's an additional deduction. And if you start to look at adding in the HSA contributions into your plan, then maybe it makes sense to do Roth contributions in your 401k. Looking at all these different pieces. But the HSA is nice because while you're working and you've got some health expenses, you can use that money for health costs. But once you retire, then it becomes your health cost bucket where you can pull money out to pay premiums and health, health expenses.
You can pay Medicare premiums with this too, can't you?
You can.
Yeah.
Yeah. And so growing that bucket is also extremely valuable because, like we said, you get a deduction now, it grows tax deferred, but it comes out tax free for you.
And it's not like the other version of the plan. I forget the name of it off the top of my head while we're saying this, but this is not a use it or lose it too. So that's another great feature. This just builds, and you can even invest as it's building if you want to. Well, so it can be a little tricky. It can be a little complicated. So you want to make sure that you're talking with your advisor, but anybody who's got one, I mean, everybody I know that's got one, my wife and I have it. We love it. It's awesome.
Yeah. You're talking about the flexible spending account, which has to be spent in the year that you contribute to it. But the HSA, funds can be pushed out, and years that you have high healthcare expenses, it's there and it's available. Years that you have low expenses, it's just going to continue to grow for you.
And there's it's not a wild story. I just saw it a couple of years ago, but there's that, it sticks in my brain. So I talk about it often when I'm thinking about the HSAs, but if you do pay out of pocket for stuff and you have an HSA, keep your receipts. And there's a lot of it comes down to tracking so that you have the receipts for it, but you can reimburse yourself as well. Like I saw a news article a couple of years ago, a guy bought himself a sailboat with all the proceeds from his HSA because he had been paying out of pocket and he had the receipts for it. Right. So, because the money's yours, you can use it for what you want as long as it's you're reimbursing those qualified medical things.
Well, and there's a lot of things that are considered qualified medical expenses. Fitness equipment, gym memberships, like all those things that would benefit your health can be used.
Nice. Well, it is April, and we tend to think of the annual tax thing, right? So all the stuff that we're talking about, yeah, you may, if you want to make some changes to your strategy, talk with your HR, talk with your financial advisor, if you need to make some tweaks along the way to be better prepared for next tax season in 25. But it's also more about just looking ahead more than just one calendar year, right? Or even backwards one calendar year. That's the difference between tax prep and tax planning. And when you're working with a financial professional, you guys are talking about things, thinking about the tax ramifications, long term versus just the past year.
Exactly. I mean, let's face it. Even my own CPA, which he's a great guy, but he focuses on the year in
the year that was.
Mirror,
right? Well, that's his job, though, right? I mean, that's cool. That's what his job is.
And there's some strategies that could be put in place from a business owner perspective, et cetera. But most CPAs are going to just gather your docs and they're going to say, here's what you owe, and sorry. But
right.
But real proactive tax planning takes into account a lot of different aspects. And we've got a number of families this year that received inheritance, and unfortunately this year they've had a bigger tax bill because when they inherited the money, it grew, and then they traded out of the holdings that they had, so they had some gains, and that happens. But moving forward, by putting a proper tax strategy in place, as we reviewed with this plan, like their taxable income from their portfolio by doing what we call tax harvesting is really minimal this year, even though their portfolios had gains. And then using the proper type of dividends, whether it's qualified, which are taxed differently versus ordinary, having a real proactive tax plan, we can mitigate some of that unnecessary taxation. But in a lot of cases, we've got to get through kind of that first wonky year.
Right.
That comes with, inheritance or a death or a retirement, whatever it may be. And then the tax plan can smooth out for the future.
Gotcha. Well, as always, folks, we're sharing, these are just the numbers that are available for this year. Before you take any action on how you implement stuff and what you do, don't go pulling extra money out or changing your something or another until you talk with your qualified financial professional based on something you hear on our podcast or any other financial stuff that's out there. You always want to see how it's going to relate to your unique situation. So make sure you're getting onto the calendar and having a conversation with somebody. And if you need some help, Sean and his team are here to help. They help folks all around the country, not just in their main Utah area. So if you need some help, reach out to them. We got all the show links in the descriptions below of the content, whether it's Apple or Spotify or YouTube. But you can also find them at elevatemyretirement.com. That's elevatemyretirement.com. And don't forget to click on the subscribe button, support the channel, catch new episodes when they come out, ring the notifications bell, little thumbs up, all that good jazz. And we certainly would appreciate it. And we'll see you next time here on the podcast. Sean, thanks for breaking it down, buddy.
Absolutely. Thank you.
I always appreciate you. We'll catch you later on here on Retirement Elevated with Sean Lee.
This video has been prepared for educational and marketing purposes only. The information in this video is general in nature, does not constitute personalized investment advice, and does not provide a complete analysis of the subjects discussed. All investments involve risk, and different types of investments involve varying degrees of risk. There can be no assurance that any specific investment strategy will be profitable or suitable to you. Additionally, although information presented in this video is believed to be factual and up to date, we do not guarantee its accuracy. You should consult an attorney or tax professional regarding your specific legal or tax situation and should consult a professional advisor before implementing any of the strategies mentioned in this video. Investment advisory services are offered through Elevated Capital Advisors LLC, an SEC-registered investment advisor affiliated with Elevated Retirement Group LLC. Registration as an investment advisor does not constitute an endorsement of Elevated Capital Advisors LLC by securities regulators, nor does it indicate that the firm has attained a particular level of skill or ability. Insurance advice and products may be offered by a third-party insurance producer, which may be affiliated with Elevated Retirement Group LLC and Elevated Capital Advisors LLC. Mark Killian and Third Wheel Media LLC receive compensation for their assistance in preparing and hosting this video.